Yeah, good morning and welcome to this webinar. Yes, uh, for the last few days, I've been getting a few calls from clients, I mean, also prospective clients, etc. And people I've met also, have been a little apprehensive because I think the frequent thing that I hear is markets are at a high, right? So, do you think markets are going to have a steep fall? Even yesterday, one of our family office clients sent a message that do you think markets can fall more than 20% in the next 6 months? So there are definitely, concerns that are there from where the market is. Okay. So today we'll try and take you through our perspective of it. We always have a, view on markets and I think, we go by data and hopefully that'll help you, make a decision on your investing. Okay. So, uh, I think there was a trigger somewhere last week, and this whole yen carry trade unwinding. What does this mean? It's basically that, uh, interest rates in Japan have been really low for a long period of time. And what investors would do at a global level, they would borrow from Japan and go and invest it, globally and make an arbitrage. Right. So that has been there for a long period of time. Japan has not increased interest rates for decades. Okay, and while other central banks have done, Bank of Japan has been, very, very uh, dovish. Okay, and however, after a long time, they came back and decided to increase interest rates by 0.25%. So, which is where, actually, Japanese markets were really spooked at. We saw an unimaginable fall on a single day, and that also had its ripple effects. So the question, in everybody's mind is, how this is going to impact. Yes, you can find that there have been a lot of investments that have come to India, which are yen denominated, and one would assume that some of good part of this will be, uh, trade on that basis. So that definitely, means that there could be impacts. However, the question is what has happened with it in the past, right? So, and have we seen the unwinding of the yen carry trades happen in the past? We've seen it from Feb 18 onwards to almost April 20. We saw it unwinding, and even right up to November 22, when the investment started coming in from Japan. So one doesn't, at least if you look at this period of time, it may not have such a large impact on India because in this period, actually, markets have done very well and gone up despite the yen-denominated assets having fallen. So yes, in recent times it has gone up 3x, but I think that is increased to almost like 21 billion, in 24. Uh, the question is it really large to have a big significant impact in India? I think Indian markets have grown well from there, and today, the SIP side itself, there's more than that which comes in. There also, I think the volatility also got increased because, the various factors that played in together, right? So you had the yen carry trade and you had soaring debt levels. There were concerns on the US, specifically the US employment, the unemployment data was weaker than expected. And suddenly from nowhere, you found one new geopolitical tension which sort of came in, from Iran, right? So that is something which all came together and we saw some bit of volatility out there. So from here, I will, request Taran to trigger the first poll. Okay. Uh, so basically, the point that I'm making is in 3 to 6 months, I expect the market to fall by 10, be flat, or go by over 10. Okay. Yes, we do a few more seconds for people to cast that poll. Yeah, thank you. And here are the results. Okay, so it's interesting that most people expect, markets to be flat. Okay, between -10 to +10, 58% of them expect markets to be flat. Uh, the second most is, 33% expects markets to fall by over 10%. Okay, so that's a reasonably negative view that, people have, I think. And we about 9% expected to go above 10. Okay, so uh, I normally say, and I've been contrarian. So typically I like to do the opposite of what, a larger group or set of people fall for. So I think time will tell, whether we see and expect markets to go up by about 10% in the next 3 to 6 months. So this time I'll do one more, okay? And if I go on with the presentation, the second poll, are small caps overvalued? Okay, because again, there have been concerns of a lot of people that small caps have run up very, very sharply. So I'll request Sarah again to bring up the second poll. Okay, we'll give a few more seconds for people to make their poll. Okay, thank you. And here are the results. This is interesting that almost 79% believe that small caps are overvalued. Okay, and only 21% believe it's not overvalued. So again, I think you have all been decisive in your polling this time. Okay, and so it's interesting. So let me now, on that basis, give my perspectives. Okay, and uh, I think let's to start off with macros and markets. Okay, so macroeconomic factors and markets, and maybe try and answer some of these questions of ours. Okay, so first of all, I think the big picture is while there are a lot of global factors, okay, the high debt levels, the macroeconomics of and demographics, importantly, of many countries are not good. Even countries like China have sort of gone into a poor demographics. Right now, the population has been aging. US also, which was in a baby boomers phase and saw great secular growth in that period of time, also got into higher. All of those baby boomers now are aged, right? So that is also impacting in some of it. There are concerns of US recession, and US is important uh, because they say that when the US sneezes, the world catches the flu. So, so that is something which is there. And yes, it is the biggest market and money flow is significant moving in and out from there. So that's going to be something to watch out for. And we'll also talk about, what we think versus that. And interestingly, there are geopolitical tensions, and to maybe an extent that we've not seen, in the past. Okay, so and so many of them, coming together, right? Because in the last slide when I was just capturing it, I said, "Oh my, there's so many of them which are simultaneously running out there." So that is something which definitely, has a bit of a risk. However, I think on the domestic side, domestic economy has been very healthy. The macros are great, and demographics are great. In fact, we are on the cusp of the period I spoke of a baby boomers in the US. Okay, we are at a median age just 1 or 2 years away from the period where the US saw a big, multi-decade bull run, based on the, demographics, because a lot of, younger people got into the working age, and that created a whole lot of spending and demand in the economy, and so the economy did very well. Interestingly, our balance sheet also is, has been healthy. I think India is one of the few countries which is continuing to work on fiscal deficits, have targets and work towards them. I think that's sort of fantastic. There are a lot of domestic triggers. Uh, you know, Demographics is one of them, but you also have a whole lot of stuff around, global, which is China plus one, etc., and the need to, move out right now. Certainly, one of us, heard about Bangladesh plus one, because Bangladesh is very large in the textile segment, and you also have structural reforms, that have been playing out and sort of doing pretty well for us. And most importantly, I think what drives markets is profitability growth, which is earnings growth as we call it. Okay, so which means this is the profit after tax, PAT, of the Nifty 500 companies. And you can see that, the growth has been very, very good. Okay, so it has gone back to like, growth around the 2003 to 2008 levels, where the index really flew and went up many times in that period of time. In fact, our view has been, and even in past webinars, I've compared and said that we believe that we are in a period like 2003 to 2008, so multi-decades for an extended period of time. And you will find that in the last few years, the spikes have been even larger. So that is something that we sort of keep in mind. So I think if I look at one of the single most important drivers for stock price growth is how is the earnings growth of those companies. That is, what is the profitability and how is the profitability growth basically. India has been the World Bank chief also, I think, at some point gave a comment that India is one of the few, or possibly the only shining star in the global economy. So that is, it's also showing up, and I think that is likely to continue to improve, including in terms of, GDP growth and numbers as you see. The point that comes up is, are the valuations high enough? Okay, because what can happen is, and you will find in each of these bull markets, the spikes at the end are very, are pretty exponential, if you see, right? So, and pretty vertical. And that is the thing. So the question is, if I go back and look at some of these, and I don't know if you're able to see my cursor, but, if I see the 2020, whether it is something like this, where there's a pause in between before a long jump and a more of a vertical rise. So, and we believe that, we're likely to see a strong move, and we're probably is still in a early to mid cycle in this bull run is what our view is. Okay, and that includes mid caps, small caps, and large caps together put together. We'll spend a separate, because that was one of the polls that also that we ran, and there was a view that small caps are overvalued. So we have one slide specifically on that, and we'll come to that as part of this segment of macros and markets. Okay, and so also looking at, I think one thing that gives us a lot of confidence, and because it is a factor that has played out globally, and it's also important to see from, let's say, the US, etc. Okay, because that is where also some bit of the concerns are, is that of interest rates. Okay, now the good part of it, and I think that it's really good. In the past, I was concerned that interest rates were not high enough for there to be significant Fed rate cuts if there were issues that we had. Okay, so on the right hand side, you have, for example, the interest rates, and you can see we are reasonably close to, rate hikes closer to the 2008 levels. Okay, now if you look at this, the orange line and the graph that is going up, right, the thick orange line graph. Okay, that is basically the Fed, when it cut rates or increased rates. Okay, so you will find that, markets even after the first few rate cuts, continued to move up in most cases. Okay. And it's moved up for a period of time, including up to, say, a year or so. So the point I'm making is, uh, even if there are concerns, even if the US economy is likely to come off, okay, one believes that it doesn't come off so early. First, you will find a few interest rate cuts. And actually, the worst point is where, the cuts are over by the Fed. So you'll find that, that from there, of course, it's almost impossible to predict where they stop. Okay, but if you got it right on the rate cuts and where they are stopping, you will find that, from there, markets actually see a non-linear rally. So, to the point I'm making here again, I think even looking at this, and this is, I think, a significant factor because the fears are more coming from global and the US. Okay, so, and if the US has to come off, like I said, if US is impacted, there definitely will be volatility that India will see. Okay, but the point I'm making is that by looking at Fed rate cuts, I think maybe after one or two cuts is where we should start getting a little more conservative. Not yet is our point of view. And for many who say that markets are overvalued and markets are at a high, etc., it's important to look at valuations from a relative standpoint and not an absolute standpoint. Okay. And the black graph on the left hand side, the black line, is basically the Nifty, and the EPS growth is what is, and the EPS is what is the orange line. And you will find that interestingly, right now, the orange line is growing faster than the Nifty, which basically means that earnings are growing faster than the Nifty. So we are, at least I'm not sure where these concerns are, that, okay, markets are overvalued. So if I just go by a simple measure that are earnings growing faster or the market is growing faster, earnings are growing faster, and you will see that in the past, when the black line goes significantly above the orange line, okay, is where you end up seeing market volatility. Okay, so that is the point that not only does the black line, which is the Nifty, have time to catch up with the EPS growth, but it is to go past it, okay, for you to actually see, larger market falls. So that is the point. The second point is, the top right hand part. If you look at the chart that you have there, again, if you look at the Nifty P, the, the Nifty P again, it's not too bad. It's 22.67. So if you're at 22.67, you will find that the falls are never too large. Okay, and the falls have been large, and obviously the point is it's not really. In fact, it's a good valuation. It's still a valuation for somebody to invest into. Yes, it's not as good as what it was in June of 22, right, when it was 20.41, or just at the bottom of the, when we saw in 23, etc., also around April and stuff like that. It is not as low as it there, but definitely it's just the PE ratio is just about 10% higher than what it was at that point of time. And typically we get concerned when the PE goes up to 28 times, okay, or 29 times. In fact, that's when, as rate rises, we ended up booking profits, including on our portfolios, and took a conservative stance. Okay, in October to December of 2019, that is what it was. So we took a conservative stance there. So the point I'm making is that if I look at, again, from a valuation standpoint, we don't think that markets are overvalued at all. Earnings, the profits are growing faster than the stock price. So I think that, we are still in a comfortable point. The other question that, in the small cap, right, is it sort of overvalued? What is very interesting again, right, is if you see for the small caps and versus the mid caps, the index returns for the mid caps in a 5-year period was 22%, while the EPS grew 23% in that period. So the PE went up a little. Rather, the index did not go up as much as the EPS growth. Right. So whereas if you look at the small caps, on a 5-year basis, earnings grew 21%, Okay, the index grew 21% when earnings grew 28%. So there's definitely a bit of a move out there, and the PE ratio, actually fell by 5%. Okay, so these are three different numbers. So the EPS relative to the index, almost like the EPS grew faster by 7%. The P combination of price by equity, you found that the P change was only the fall was down by about 5%. So actually, if I look at a 5-year basis, it became uh, uh, you know uh, the P ratio actually fallen rather than gone up. Yes, over on a 2-year basis, there has been some catch up which is there, but it is not completely caught up with a 5-year basis, right? But even there, if I see the mid cap, interestingly, the index has grown 26% when the EPS grew up 13. Okay, so and then the P change also is gone higher. So actually, if you go back and look at it, the small cap index has always commanded a much, much higher P ratio. So if you look at absolute numbers, maybe you may feel okay, it is the highest, but if you go back in the past, it's not unusual to even see 50 times, 50x, as the P of the small cap index. When it's a little bit of overwhelm. So the point we are making is still, if we look at even the mid and small cap, our view is that we don't think even the mid and small caps are overvalued. Okay, and small caps especially, I think, have some more room to grow is what our view is. Okay, and so we are sticking our neck out on that, and I think time will tell us, where we are there. And the other point is to look at, the tendency to say, oh, this time, small caps gone up very sharply. Yes, uh, if you go and see history, it's not unusual to see a 3 times growth in the small cap index, right? So whether it was 2008 where you have a 3x growth, or a 2010 again you had a 3.4x growth. In 2013 was a lot more sideways market. So there was also deleveraging period for India. So you found that it was relatively, 1.4x is also decent, but it was after correction, it was followed up by 2.4. Jan 18 again at 2.2. Okay, so if I go back and see even from the past rallies that we have seen, one doesn't think that you have seen a large enough rally for it to be really concerned about. So coming back to sectors and themes, okay, uh, you know, what is interesting, and this is also something that we want to highlight, okay, is if we looked at, this is a nice study by PGIM, okay, and they looked at companies which are, quality and growth, and quality or growth, right? So either one of those parameters, okay. And if we went back and looked at it, okay, in the past, 10-year basis, quality and growth are the highest. Okay, which should be. Should be the good quality, which means the profitability is decent and stuff. Okay, they're able to see a good return on capital employed, and parameters like that. And versus that, if you look at only growth is just saying that how they are growth oriented companies and not value companies. Okay, so those type of companies ended up seeing almost like the highest on a 10-year basis. That's what gives the best, followed by quality or growth. So either quality or growth, if you get one parameter right, it goes up, and neither quality or growth type of company is actually do the worst. Okay. So, however, if you look at the last 1 year, okay, it's like what I say, junk has run out. Okay, so quality and growth has been the least performer. Quality or growth has been next, but you see the gap between them, right? So, even between quality or growth, 33 to 59%, neither quality nor growth has grown 59%. So the point I'm making is that portfolios, and this is why you have to be a little cautious as you go forward. Portfolios which uh, have poor quality, right, may perform better, or mostly would have performed better by this data. Okay, so you may find the best portfolio managers at this point of time actually underperform. Okay, and one of the points that we are also saying is, as right horizons, okay, the good part is we've not, we've been sort of in line or better than the index, and I'll share you the numbers there. Okay, but there could be, some of the fund houses that have done better than us, and because we will continue to focus on both quality and growth. Okay, but we've been able to identify better timings and better set of companies within this whole universe. I think, okay, we've been a little better off. But the point is, you cannot go completely still against the tide. So at a period like this, we are saying that we don't mind being in line or underperforming the index as well in the short term. So, and we do not want to optimize on, both of these parameters are important for the way we construct our portfolios. Okay, but in the long term, we are sure that, the fall will be lesser, and eventually we'll come back to the long-term averages, and you will find that quality and growth will be the ones which prevail. And this is the other part that you have to be careful about, because the point is, uh, it's, the returns are very, very dependent on the quality of the companies. Okay. Uh, so you'll find that in the BSE, the top quartile average is 37% in terms of 10-year compounded annual growth, okay, in the stock price. So on the other hand, if you looked at it, the bottom quartile is 8.2% over the whole 10-year period, right? So you have to be, especially when you're looking at small caps, it is very, very, very important to have quality and be, in your top performing ones. I'll not spend too much of time on this because there's a lot of detail out there, but the point that one is making is that, uh, sector-wise also, there are ones which, are cyclical and they are doing better right now. Okay, so, but one has to be watchful of the cycle and where it is, and accordingly, you have to ride and take advantage of it. But at some point of time, for cyclicals, you have to jump off and on the other side. Okay, so there are some of the, so we have always had a thing of booking profits, and we in fact made a methodology itself saying how do you identify multi-baggers. Okay, and we also have various webinars that we've done to explain what this multi-bagger methodology is. Okay, and we'll probably spend a couple of minutes also later. But the point is, we have as an organization, we're happy when we've got multi-baggers, and we find that valuations are higher and we are uncomfortable, we also exit those. Even if some companies would have gone up further, okay, but that's not, point that we are really, bothered about, but because we'll go back and find other companies which are better valuations and, are become multi-baggers for the future from there. The themes of 2024, again, we still believe that there are opportunities, in various things. Yes, some of them are coming back to our core sectors. Some of them are also a little bit of cyclical sectors. But yes, I think we believe that there is still opportunity there. And what we do is we look for companies which are, at a lower valuation. So the P multiple is lower than, let's say, the industry leader or the average of the sector. And so that gives us an extra growth apart from the same company which, delivers good, EPS growth. So our multi-bagger methodology is just a simple framework where we're saying we expect the company to double in their profitability over the next 3 to 4 years, and the valuation is lower. So just from the earnings doubling over the next 3 to 4 years, ideally you should see the doubling of the company, but the extra, compounding that you get and extra price growth that you get comes from also re-rating that happens on the PE also going up along with. So you'll find, typically your return will be, the PE into, your earnings growth. So everything, is everything hunky-dory, everything is good. We'll continue to watch out for the risks, and definitely they are there. Like I was saying, just capturing it, I say already simultaneously together, you have right from China, Taiwan, We have Russia, Ukraine, Israel, Iran, and we almost forgotten, the other Israel-Palestine side there. So there's so many things running simultaneously out there. Um, Definitely, and recently we also saw some bit of stuff around Bangladesh. So things have been, geopolitical risks are definitely very, very high at this point of time, and that is a risk. And if it sort of catches up to India, so the thing with markets is that typically, unless it's, let's say, a market that you're exporting to, or like in recent times, there was some reports on a few companies, the supply chain will get impacted because of Bangladesh, okay, including Indian companies, and some of the big names also have, some of the manufacturing and supplies chain coming from there. So those could get temporarily impacted, or there could be a higher impact. But if not, okay, in most cases, it doesn't really impact thing, unless there's a much larger. Last time, the Russia-Ukraine conflict ended up impacting commodities in a significant way, right? So unless there's some impacts that way, we are unlikely to see too much of an issue. Um, Weak jobless data, slowdown risk in the US, and the tech peaking. Okay, so all of these are definite concerns, and we continue to be watchful. In fact, we have been watchful in the recent past of the US, because our view is, whichever the country of the last decade, okay, typically, ends up underperforming for even a couple of decades. So for a long-term view, it's reasonably negative, but in the short term, we still think the cycle is not played out completely for it to go off downgrade. Okay, so rate cuts have been a little bit delayed. Okay, which in some ways is also okay, because then there's more headroom left for markets. Like in the data that we saw, right? You found markets fall after a few rate cuts. So if the rate cut itself doesn't happen, okay, it means that the economy is slightly better than what everybody perceived it to be, right? And at least central governments are not perceiving it to be, really bad there. And rate cuts are in some form an acknowledgement that, and it will always be that way. The rate cuts will happen when the economy it begins to start performing poor, right? So that's the whole reason why central banks, come out and do their rate cuts. And yes, so there's also been somewhat a bit of fiscal tightening because deficits are a concern in all of those. So there has been some bit of tightening that central banks and governments, more than central banks, are been trying to do, and they need to do as well, lest they find bigger issues as they go ahead in the past. The domestic macro, there have been fears of a slowdown. Some company results have been not in line. Okay, but I think the broader market, and some of the mid and small caps, some of the stocks have done very well. So it's important now to start looking at how, at a stock level, etc. It's becoming more important to just, cannot take a general swipe and where they say spray and pray kind of approach will not help. You have to be very selective in terms of choosing your stocks and sectors, etc. The FI outflows from emerging markets has been something we think it will actually reverse, and that may give the last impetus for the Indian markets and also global emerging markets. And definitely there's been a slowdown in job creation in the US, and unemployment data, etc., etc. Right. So these are macro risks. Yes, there are risks that we are always looking for on a continuous basis, right from at a company level, right from business risk, valuation risk, governance risk, etc. Okay, that's something that we do. We don't, and this part is about the controlling part. We are saying balancing risk and return, and how we do that, right? And what are you and how you can look at it as you go forward, and how we manage your portfolio. One of the things we don't do is we don't look at companies which don't have either a good market share, addressable market share, when the promoter holdings are too low, or the balance sheets are poor and highly leveraged, or, you find that profitability is not, the path to profitability is not visible. Okay, they have poor disclosure. Those are companies that we don't typically invest in. We also have a very, very structured investment process. We've broken our whole investment journey, had our PMS into 4 parts, right from the screening of companies to evaluation, within evaluation, we do a ranking of companies and then further do a deep dive into each of them to look at various other strategic factors, etc. We have a whole full-fledged risk radar where this goes right through before we invest into a stock and after we invest, as well as the timing of our purchases, which is looking at valuations. The pendulum sort of gives us a range within which we are able to buy and sell, some of the stocks that we got on our PMS. I just already spoke about a multi-mega framework, which is a combination of looking at business risk double in the next 3 to 5 years, and where the valuation can improve. That is, they are at a bit of a discount to the current valuation. And this has been the performance of our portfolios. Yes, there are. This is as per the SEBI benchmarks. You find the the benchmarks of the mid and small cap would be higher and different as well. Okay, but broadly, our point also has been that how we are able to deliver good and consistent returns and compound them, and more importantly, manage risk so that they don't come off. And broadly, to conclude, okay, just and to summarize, the point is whether markets are at an all-time high is irrelevant. So if you look at all the newspaper, the markets at a high, people tell you markets at a high. In absolute terms, it's irrelevant because the index is only a weighted average of the underlying stocks. The underlying stocks will become bigger and bigger, and the profits will go higher and higher. And as that happens, there's actually no limit to the index, and going high is not a reflection of whether it is overvalued or undervalued. What's important to look at, how is the particular company versus its earnings. Okay, so which is what we call it valuations. Okay, and there are different ways to look at valuations, but one of the simplest ways is to look at price by earnings, as they say. So this is basically the stock price divided by EPS. And if that is so, if the price is many times EPS, it means overvalued. If it's lower, then it's not as much. And then typically we'll go back and see versus history where has the valuation been. Again, you'll see within the sector, how valuations have been. So that is something to look at, and we wanted to share in that both for the Nifty as well as for the mid and small caps. Okay, we definitely not looking like very stretched in terms of valuations. And so that's why we think there's some bit of steam left. Markets did correct due to various news flows and events, all of them coming together. And actually that is good. Markets correcting actually is a very, very good aspect. And I think if you're a disciplined investor and you manage risk well, then I don't think you should be concerned about it. And so these basically could be opportunities to take advantage of. Okay, and yes, we have to be watchful of a turning point in the US. Okay, but we are very, very comfortable with domestic factors. At some point, this can, impact. Okay, because like I said, when the cycle turns in the US, there'll definitely be a short-term impact. But we don't think that is, it's going to be, even in the US, we don't think it's going to be really in the short term. Okay, so now we continue to believe that in the long term, the big picture, we still believe India is the country of this decade and going to do very well. A lot of factors just coming together for it. Okay, from our side as Right Horizons, we will be continued to be disciplined in our investing, because we think doing the silly things, the very boring things rather, are important, and how you can make process, the king, and that is something that we have tried to do, and we will continue to be disciplined in our investing style. We will not get carried away by things, but yes, we will take advantage of opportunities that come up. Okay, we may calibrate our risk and take higher risk at certain point of time, and we think this is an environment to take higher risk. At some point, we can go much more conservative, and those are things that we continue to do and will do. We'll continue to look at data rather than looking at getting carried away by various news flow. It's like this today morning I had an interaction with one of these investors, and he said, "Ha, Anil, now I think I should stop looking at all these YouTube videos." Yes, there's a lot of social media thing that comes in, okay, and it may make you do the wrong things. Okay, so what we should rather do is look at data. And because he asked me, what do you think markets will fall 20% in the next 3 to 6 months? I said if it falls 20%, it means our valuations are 18.7 on the PE ratio, which is far lower than COVID. So do you think this environment is as challenging as COVID? Right? So that is the point that is that, we need to keep in mind that look at data, look at underlying, and then take decisions out there. Investors can continue to, we believe, continue to make allocations to equity even now, and a wider one. Yes, don't put all your money into mid and small caps. Okay, spread it out. At this point in time, we think that large caps also will come and catch up, because we believe at some point of time FIs will come back to India, and they will also create a bit of a spike in large caps, because they need that size of market cap for them to invest larger sums of money. Okay. However, the point we would like to make is as markets continue to go up, this will keep increasing. Right? We saw the last leg of the market, this typical vertical up move, but when it moves down, also the move down is vertical. So we have to be even more cautious as we get into a higher risk. As writers, we will continue to keep booking profits, continue doing various things to manage the risk more actively. And I would like to end with this quote. It says, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves.